Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today, I'm going to answer some questions. Some people had some questions in the comments section. This is over time. How did I choose SM Energy, Centennial Resource Development, and some of these other companies and sectors? Now, what I do is I just think about things. That's literally all I do. I think, I ponder, I say, what have previous bull markets returned in some of these sectors? What is the leverage to the move? That is really what I was trying to answer in all of these questions. Because I've got, I've got my kind of safer physical metals real estate type portfolio. And then I'm just going to guess, 30 to 40% of my money in equities. Half of that's in like 401k and other things. And then the other half is where I swing for the fences. If I'm going to swing for the fences, I am looking for leverage. And leverage isn't going on margin and borrowing money to make money. Leverage is in the companies themselves. It could be high debt that they have. So you can leverage up and go on margin yourself, or the companies that you buy can have a lot of debt. And if what they sell is inflation or indexed to inflation or goes up during inflationary periods and is highly leveraged under those scenarios, the commodity price, that debt could be inflated away. So you could find incredible deals at bottoms for some of these high debt, higher cost producer companies because they were playing with the edge of bankruptcy at the bottoms of these. So I was looking for leverage. I'm looking for bounce. I'm looking for, if I were to squeeze this orange and want a bunch of juice, I want a tsunami of juice just, drenching me when I squeeze this orange of how much juice I'm going to get out of this squeeze. And remember, short sellers, all these people jump on these companies that are about to go bankrupt, and then it all has to reverse on the upside. So you've got short covering, you've got short squeeze, all of those things. So what I do is I looked at, I'll just start with some of the oil companies. The ratios were incredibly cheap. They were over 50 barrels to 1 ounce gold. That is an anomaly. When I sat down and thought about the scenario, I looked at the conditions around oil, and there was a couple of things that stood out quite dramatic to me. I mean, like they just stood out like plain as day. Oil didn't crash because of a recession. It crashed because they stopped it. That means that on the back side of this, if they open things back up, you're going to see this huge ramp of demand. And on the side of the crash that we just had, and that ratio that got all the way to like 90 to 1, and you looked at the response to the oil companies, they put all these hedges in place, they cut back on spending, they did all these things, they reduced their drill rigs and what they're drilling for and all that stuff. And I was thinking, this could be the biggest squeeze in oil that I've ever seen. One, we're starting from the lowest valuations that I've ever seen, number one. Number two, we could compress this ratio the most that I've ever seen in any bull market in the shortest period of time. And then you start looking at this, we'll call it the environment, I should say climate, the climate change stuff, and how the ESG movement is literally starving oil of investment. So I'm looking at this going, this is going to be the biggest short squeeze that we have ever seen. And in all honesty, maybe they're doing this on purpose because it doesn't make sense to me. And I just happened to stumble upon it. They're literally not investing in oil, which is the number one commodity. I mean, just think of this setup, guys. This is ridiculous. All right. We went to ridiculously low levels. They cut back spending. We have demand coming back, not from a recession, but more from a stoppage, which means we're coming full bore. They dump all of this money in to the soup, stirring this soup up with all this money. Oil is one of the biggest inflation sensitive assets of anything. They're starving investment to oil. It's the number one commodity that human beings use in a variety of things. I mean, I'm sitting back looking at this going, this is ludicrous. Absolutely ludicrous. Then on the opposite end of this, they've got this ESG thing, right? ESG has basically forced all these companies to put in the transitional fuel of natural gas. And what do these oil companies produce? Oil and natural gas. And I'm looking at inventories of natural gas. In 2019, they have a liquefied natural gas problem in China. And then you like start piecing this all together. I'm going, oh my God, this is the biggest opportunity that I've ever seen. I couldn't sleep at night for like a week because I was looking at these companies going, I should add more. I should put more in there. And I was like, which one should I choose? That's the question. How did I choose where to go? And I knew that oil and natural gas were going to be like massively good. I also know that uranium is going to be good because if you have an energy crisis, uranium is energy. And in uranium, you've got a very similar scenario. It's clean. It produces electricity. That's the direction we want to go. It has a high energy return on energy invested. You start going down all these lines, and then it's like, okay, there's like 60 companies in this sector. It's got one of the most highly leveraged uranium price moves. In uranium, the price can go all like just ridiculously high in relationship to its starting point and in relationship to gold. And it has a very inelastic demand. It's super unique. So not only has previous bull markets been insane, we've got this deficit that's out in front of us for uranium that's massive. So I've got oil, natural gas, we've got this ESG movement, and we've got uranium, which is an inelastic demand with a huge supply deficit coming in front of us. These are a recipe for something that you have to look at, in my opinion, if you're an investor. It's like, it's ridiculous. Now, looking at the valuation metrics of uranium when I was looking at this, it was at 62 pounds to 1 ounce of gold. That's ridiculous, guys. It should never be priced that low. But it was. It's now at 40 something, which is still ridiculously cheap. So it means that the valuation runway, your risk reward on these bets are bar none the best I've ever seen of anything in the market. What would you do if you knew that? Well, you're gonna go after the highly leveraged companies. Why would I go after the highly leveraged companies? Because it's the lowest risk time to do it with the most potential in front of it. So you want to pile into, at that time, oil, natural gas, and uranium companies. That's exactly what I did. Now I've got some charts up here that I created. They're made by me. I'll zoom in a little bit on it, get a little bit more so you guys can see this. So this is the uranium price that I have here. It's right here, this chart. And what I did, is I got the ratio on the x-axis and the price on the y-axis. And some of you guys may have seen this before. And as we compress the ratio from right to left, this is your leverage that you get in relationship to the gold price. A $2,000 gold price, a $5,000 gold price, and a $10,000 gold price, and a 15 if we get that high. And I don't know where we're going to get, and I don't know when uranium's going to peak in relationship to the gold price. But you can tell if we go below 10, we start going vertical. It starts to go exponential and really start to turn up. And especially if you go up in gold price, which means if you start to compress and we get a huge squeeze going, and you've got this money all in the system, it's going to compress and really start to move upward. So uranium has massive leverage, probably one of the best sectors for a leverage play to commodities. And this is one of the reasons why I got so drawn to uranium. I also have the oil projections. Massive leverage when you start moving up. See how that turns up? So this is obviously the ratio on the bottom. I was buying at over 50. I was over here, and it's going to compress all the way, and we could compress quite dramatically if it gets below 10. How does it get below 10? That's your supply-demand balance. If we have market deficits or we try to go to market deficit, it's going to really ramp the price up. And that's the underinvestment in oil, oil being the number one commodity, et cetera, et cetera. That's where it really entices me. And the one below this is natural gas, and natural gas has massive leverage. It's just massive, guys. See if I can come back here. Natural gas price projections versus gold, and they just move like heck to the upside given history and the compression of the ratio. And remember, natural gas is a multi-leveraged ratio bet because natural gas and oil are also a ratio. So oil is going to go up in relationship to gold, and natural gas is going to go up in relationship to oil. And that's why you see this massive move and the compression of the ratio, because it's a double ratio bet. And then we've got platinum up here. Platinum doesn't have that leverage. We're going left to right because we're going to increase the ratio against gold, not decrease it. And you can see these price projections and the leverage that you could potentially have. Now, I was looking at all these different assets. This is your valuation and your runway for that valuation increase. Platinum may not look like it has as much leverage, but it has leverage all the way to the end, while oil, natural gas, and uranium may peak sooner against gold. So gold may be at a lower valuation when it peaks in its ratio versus platinum, where they're at much higher, gold's at a much higher price. And remember, this stuff isn't exact. It's not necessarily 100% in the bag. So you want to diversify out and make sure that you're spreading out. Silver's another really good leverage bet. Platinum, silver, uranium, natural gas, oil, copper, I think is going to do very well as well, and some of these other base metals. So how did I choose those companies? What did I look at? And I know this is going to sound pretty weird, all right? So when you look at history, or when you look at nature, not history, but nature, there's things called fractals. And fractals are in nature. You can find them all over the place. Think of it like a seashell. And what I was seeing in these is I was looking at the pattern at the bottom. It's this pattern that's right next to me. Yeah, that way. That thing right there. That first move up and down. I said the ones with the biggest bounce could be the ones that lead the most. They appreciate the most. Why? Because of, think of it as like fractals. Like you got the first move, it comes back, and then you got a second move, and then a third move. Think of it like Elliott wave. The bigger the first move, in my mind, would lead to larger moves past that. So if you look at SM Energy here, I've got it right behind me, and I looked at this bottom to this top here. That move was a prelude to how big the move, in my opinion, was coming. So SM Energy had a massive move of under $1 to all the way almost to about $7.50 in just one impulse move up. It came back, and the way that this thing moved, the volume increase, the large candlestick up days, and the slow leak off of sellers said that this thing was primed to go at this bottom here. You also had a downtrend. It was squaring up, coming flat, ready to turn. That's where I got extremely excited. Now, what was another company? CDEV. CDEV was a similar situation to that, and it didn't have as big of a bounce in the beginning, but it was still incredibly large. But it just wasn't as large. So I didn't put as much money. I didn't overweight it as much. But I also thought it was going to be pretty good, and it had a really good chart set up over here before this move going on up. And then another one that was really good was QEP. I can't pull it up because it got bought out by FANG. But QEP, I think, was going to be a very good one as well. And those were the three that I kind of got in really early, piled in. I got into MCF as well, but MCF had a very different looking chart. MCF looks like this, but it was still incredibly volatile coming through here. We're still trying to break out of all this. It's garbage up there. The only thing that was different with MCF, though, Contango, and I probably should have thought, looking back, is they do have new management. They bought the company out from a guy who passed away, and they used that shell of a company to start a new company. So maybe the dynamics of that and the way that this thing is trading has an impact. But those first three were the ones that I was like, man, I got to get in these. Like I got almost like I couldn't sleep at night. And then I started looking at other things as well, in terms of leverage. And when I think of things, not leverage, but what could stop the move. In oil, there's not really much you can do. You have to produce more, and this squeeze could happen. And if they continue to underinvest in oil, this squeeze could happen for, it could last for a long time. Uranium's another one where you've got this demand out there that's really resilient. It's inelastic. It can handle a huge move and not really affect the price of the consumer. So that was another thing that I was really drawn to. Plus, you can't bring this stuff online very quickly. So what do you do if you get in a scenario where you have a bad shortage? Prices are going to rocket and you have no supply response. All you have is this inelastic demand with no supply response. I'm like, that's perfect for an investment. And I'm not trading in and out of these stuff, guys. These are going to be massive moves. You just have to be patient. You buy your companies and you just sit in them. That's all you have to do. You just sit in it. How hard is it? How hard is it to sit in it? You're going to have to master your own emotions and abilities to be patient and to hold on. Now, platinum. Why did I like platinum so much? Well, one, it's the cheapest metal against all the other metals on a valuation metric. Check. Now, that's not the only thing I look at. What type of resistance to the move do we have in platinum? In gold, everything's stored. It's all above ground. It's all stored. It's got tons of inventory, above ground inventory. Silver, it's the same thing. It has a ton of inventory above ground. Everyone owns it. I own it. You guys probably own it. And a lot of other people own it. We've got silverware. We can melt this stuff down. It's in all of these products that we have. It is everywhere. Now, what about platinum? It's in catalytic converters. Yeah, we can melt those things down and recycle, but there isn't much inventory of it. I mean, there's literally nothing. Not many people own it. You've got some jewelry, but it's really minuscule, and it's like one ring or a couple rings that people own. That's like it. So it's really, really rare. And if this price gets moving, there's nothing really to stop it. Now, is there anything else that we could look at as a indicator of what platinum maybe could do? Well, yeah, we have palladium and we have rhodium. Rhodium went from $600 or $650 in 2016 to $30,000 in 2020, 2021. Palladium went from 177, 180 in 2009 as a bottom all the way to $3,000. Those are huge price moves. I think platinum could do it. And why did those things go up so much? They have no inventory. Once you get through it, there's nothing to stop the move. It just keeps going up until you hit a spot where demand starts to pull back. And then you've got all these ESG movements. What are they doing? They're loading the catalytic converters with more and more rhodium, palladium, and platinum. Platinum's a substitute for palladium. Doesn't get much better than that. And if you invest in the cheapest one, they're going to start doing substitutions. They're going to buy more platinum and try to put it in instead of others. It just seems like a really good bet because you have inelastic demand. You have not much movement that can slow the movement upward. And we've seen these platinum group metals rip it in the past. So I think that it could potentially be a really good investment. A really, really, really good investment. So those are kind of my favorite ones, just kind of off the cuff. Silver's up there too. Silver's used in everything. It's the number 2 commodity. And if you notice, I'm trying to go into metals or things that are used in everything. So if you get a price move that goes up and everyone's using it, they're using it in all sorts of things, it has the least likelihood to be substituted out if it's in everything. It's just going to be hard to get rid of it. And substitutions aren't as easy as you think. I mean, some of these metals have attributes that are not, you can't find them in other metals or other designs. So that makes them very unique and provides a lot of utility to humans. So that's some of the things that I was looking at, and hopefully this gets you a little bit better picture. Now, when I look at some of the price moves in other sectors, they don't have that same pop. They just don't. There's a few. I mean, there's some good silver company mining ones that could have some pop, but they're not. It just doesn't seem as good because of the price, the leverage of the commodity to gold. Gold is what you're kind of measuring against, and we could see some really big runs. I own mining companies and royalty companies. I do own a lot in those, so I'm not discounting them. And I own copper and I own other ones, but I just don't know if the price leverage, the leverage to the commodity, I should say the commodities leverage. There you go. The commodities leverage to gold isn't as great as, say, gold, which is the gold standard. But platinum's got some good leverage, and so does silver. Those are a double. So if you have your money supply, you've got gold here, and then you've got the leverage of silver and platinum to gold and to the money supply in these bull markets. They compress the ratio or grow that ratio against gold in a favorable way for silver and platinum. Same with uranium and oil and how it compresses natural gas. So that's kind of how I chose all these and my thought process going through it. Maybe I missed something. Maybe I didn't think something through thoroughly. Let me know if I didn't. Put it in the comment section. Love to hear your guys' opinion. If you guys have other sectors that are highly leveraged, put them in the comment section. Love to hear your guys' opinion. And another sector that I think that is highly leveraged is solar. If you see the price moves in solar and some of these other renewables, it's crazy how much they can move. So that was another area that I was very interested in. Another area as well is rare earth metals. I was looking at rare earth metals, and the price leverage, like the leverage of the moves, can be massive when you have problems in rare earths. So that was another sector that I definitely wanted some money to be exposed to. And what I'm trying to do is find the most undervalued sectors with the most leverage to price moves, and then spreading my money across them. That's exactly what I'm looking at. And then I look at the charts to see what kind of pop they've got. Think of it as some of these moves coming up, and think it as fractals, like I'm looking at the first move to project other moves forward. Hopefully this you like this, you guys like this clip. Give me a thumbs up. Subscribe to the channel if you haven't already. And thank you for listening. This is Finding Value.